Our next guest says January told a tale of two markets. Joining us is Brian Belski, CEO and CIO of Humilis Investment Strategies. Thanks for joining us today.
Hey, thanks a lot for having us. Good afternoon, Canada.
What was the big picture for January? What did it tell us?
Well, I think we saw, quite frankly, a lot of broadening out across most markets, especially in North America relative to some other areas. And so I think that's very healthy for the market. What our work has shown is that as we move more into earnings-driven markets versus the multiple-driven markets that we've seen the last couple of years in particular, especially since the fourth quarter of 2022, the return structure of those markets are much less, but they're actually more volatile. Doesn't mean it's not positive, but it just means they're going to be a little bit more volatile. Quite frankly, we think that is positive longer term as investors actually focus more on earnings and less about momentum. So I think what we're seeing in markets, despite all the volatility, is quite positive.
Okay, so what typically drives the broadening phase? What's pushing it?
Well, I think number one, you started to see this notion of dispersion. What does dispersion mean? It just means that not all stocks are created equal, and that you're starting to see differing parts of not only performance but fundamentals across, especially areas within technology. We saw a precursor to this in the fourth quarter when many of the quote-unquote Magnificent Seven stocks, or whatever you want to call them, the top 10 largest stocks in the S&P 500, begin to display differing performance. That's kind of number one. Number two, we believe that investors around North America are starting to find, quite frankly, more of the things that we're seeing and have been talking about now for several months. That's being small cap, value, dividend growth, financials, healthcare, some of these names that obviously are not technology, big cap technology names that have really demonstrated and defined much of the performance in world equities the last several years. So I think that's, again, very positive and why we've seen the broadening out.
Okay, how long can this last? Is there any indication of how long it could last?
I think it's early days. I think, a few years ago, it's interesting, we wrote about that markets are going to normalize. People kind of thought we were nuts, and I think ultimately we are going to see more normalized trading. I was a strategist back in the 90s. If you saw kind of and remember back to 95, 96 type time period where it was more earnings driven, more fundamentally driven, not just momentum, and it was right before the crazy tech stocks that went kind of parabolic in 98, 99. And so I think we're heading back into that. Maybe it's the start of some also Goldilocks the first part of this year. And then we'll see what happens with the Fed going forward. But our viewpoint is not indicative of the Fed cutting rates. It's more about earnings continue to surprise the upside to the double-digit side of things. And as stocks kind of grow into their multiple versus being driven by their multiple.
And do you think we've started to see that with the earnings so far?
We are very much so. We saw that in the U.S., and I think the big thing for Canada in the first quarter, first calendar quarter, is going to be if the banks in particular can grow into that multiple expansion that we saw last year. Clearly, the material sector has been on fire, and from an earnings growth perspective, it's going to be tough to kind of grow into the multiples in many of these growth and gold names. But, the bank area in Canada is an amazing asset class. We still love Canadian financials, but we think we have to be a lot more particular in terms of just owning all the big six. I think we want to own and be overweight, maybe one or two, not all of them.
Be selective. Okay, so Brian, we've seen small caps and mid caps take off, and as you mentioned, that's part of the broadening out. But what conditions will allow small caps to keep outperforming?
Well, I think it's performance. Performance begets performance. The old notion from the 1980s, greed is good. Probably going to get some emails about that. But from Wall Street, greed is good. I mean, we had great performance on a relative and absolute basis with respect to the small cap markets for the first time in several quarters. The last 3 months, but in January in particular, I think people were shocked by that because they've heard so much bad news about the Russell 2000 in terms of in the United States, the majority of companies don't earn money. Actually, if you take a look at the next layer down, we look at the S&P 1000 companies, the 600 mid cap and the 400 mid cap and the 600 small cap. Those companies are exquisitely positioned from our models. The way we look at that, we actually have the good fortune of running a small mid-cap SMA portfolio for clients in Canada, the United States. Be that as it may, cash flow, earnings growth, balance sheet strength and actually increase revenue strength from this asset class. That's why we're bullish on small mid-cap.
All right. So what strategies do you recommend for investors to stay focused and stay disciplined? Because we know last year was so volatile. We expect this year to be much along the same lines in the bigger picture.
Well, number one, don't get shook out on politics. Don't let that bother you. Buy really good companies. I know it sounds silly, but our confidence in the fundamental nature of both the Canadian and the U.S. stock market remain very, very high. Turn off all the noise and continue to be very poised and deliberate in your investments. So if you have a great company like Couche-Tard, which, oh, by the way, has been underperforming for a while, you really like that company, there's nothing wrong fundamentally with that company. It's just that some other areas have been outperforming. You should buy more. If you really like Waste Connections, which is another fantastic company in Canada, but maybe from the industrial sector, people have kind of forgotten about, that's an opportunity to buy more. So be disciplined in your process and discipline, stay invested. And when things seem too good on the upside, maybe you take a little bit off the table, but stay invested.
All right, Brian Belski, got to leave it there, sir. Thank you very much for your time. Appreciate it.